Welcome to Wealthfinity. Today we're discussing a topic that is at the forefront of many people's minds in the world of investing: dividends. With the stock market constantly fluctuating, it's important to understand what dividends are and how they can impact your investment strategy. In this video, we'll explore the various reactions to dividends and what they mean for investors like you. Get ready to take your understanding of this important concept to the next level. As an investor, it's important to understand all the different ways you can make money from stocks. One of these ways is through dividends. A dividend is a portion of a company's profits that is distributed to shareholders. What are dividends? Dividends are payments made to shareholders of a company, typically on a regular basis, as a way of distributing a portion of the company's profits. Dividends are usually paid in cash, but they can also be paid in the form of additional stock or other assets. Companies are not required to pay dividends, and the decision to pay them is usually made by the board of directors. How are dividends paid? Dividends are usually paid on a quarterly basis, but some companies may choose to pay them more or less frequently. To receive a dividend, you must be a shareholder of record on the date the dividend is declared. This means that you must own the stock before the ex-dividend date, which is the date when the stock starts trading without the right to receive the upcoming dividend. First, let's look at what a dividend is and why companies pay them. A dividend is a portion of a company's profits that is paid out to shareholders on a regular basis. Companies may choose to pay dividends as a way to reward their investors, show that they are profitable and financially stable, or to retain investors. In many cases, a company's decision to pay dividends is based on a combination of these factors. When a company earns a profit, it has a few options on what to do with that money. One option is to reinvest the profits back into the business, which can help the company grow and become more profitable in the long run. However, if a company has reached a certain level of success, it may decide to pay out a portion of its profits to shareholders in the form of dividends. The amount of the dividend is determined by the company's board of directors and is typically expressed as a dollar amount per share. For example, if a company has declared a dividend of 50 cents per share, a shareholder with 100 shares would receive $50 in dividends. Dividends are usually paid out on a quarterly or annual basis. It's important to note that not all companies pay dividends. Some companies choose to reinvest their profits back into the business instead of paying them out to shareholders. In these cases, investors may see the benefits of their investment through capital appreciation, or an increase in the value of their shares, instead of receiving dividends. When it comes to investing in stocks, dividends can play an important role in your investment strategy. They provide a steady stream of income, even when the stock price is not appreciating. In addition, companies that pay dividends are often seen as being more financially stable, which can be attractive to investors. However, it's important to keep in mind that a company's decision to pay dividends can change over time. If a company experiences financial difficulties, they may choose to reduce or eliminate their dividend payments. On the other hand, if a company is doing well and growing, they may increase their dividend payments. They can provide a steady stream of income and can be an important consideration when choosing which stocks to invest in. However, it's important to keep in mind that a company's decision to pay dividends can change, so it's important to do your research and regularly review your portfolio to ensure that it aligns with your investment goals. Dividends are usually paid out on a quarterly basis, but some companies choose to pay them out annually or semi-annually. They are usually paid in cash, but sometimes they are paid in the form of additional stock. The amount of the dividend that a shareholder receives is based on the number of shares they own. So, the more shares a shareholder owns, the more they will receive in dividends. This is why dividend-paying stocks are a popular choice among long-term investors. By holding onto their shares and receiving regular dividend payments, they can build a reliable stream of passive income that can help them reach their financial goals. The amount of the dividend is usually expressed as a per-share amount and is determined by the company's board of directors. The dividend amount can vary from quarter to quarter and may be increased, decreased, or suspended altogether, depending on the company's financial performance and future prospects. It's also important to note that not all stocks pay dividends. Some companies choose to reinvest their profits back into the business, while others may not have enough profits to pay out dividends. However, dividend-paying stocks can be found in many different industries, from technology and healthcare to utilities and consumer goods. How do dividends impact your investments? Dividends can have a significant impact on your investments, especially if you hold onto the stock for an extended period of time. Over time, the regular income from dividends can help to offset any fluctuations in the stock price, providing a more stable return on your investment. In addition, receiving dividends can also help to reduce your tax liability. Dividends are taxed at a lower rate than other forms of investment income, so holding on to stocks that pay dividends can be a tax-efficient way to generate income. It's important to note that not all stocks pay dividends. Some companies choose to reinvest their profits back into the business instead of distributing them to shareholders. If you're interested in investing in stocks that pay dividends, look for companies with a long history of paying dividends and a strong financial track record. Dividends can be an important part of your investment strategy, providing a steady source of income and potentially reducing your tax liability. Before investing in any stock, it's important to consider the company's dividend history and future prospects to determine if it's a good fit for your investment goals. This comprehensive guide to understanding dividends in stocks. At Wealthfinity, we believe in empowering our readers with the knowledge and resources they need to make informed investment decisions. In conclusion, the reaction to the concept of dividends in stocks is diverse and varies from person to person. Some individuals understand the value and importance of receiving dividends as a form of passive income, while others might overlook it in favor of focusing on the potential for capital gains. Regardless of one's perspective, it is evident that dividends play a crucial role in the world of investing and finance and should not be underestimated. It is important for individuals to educate themselves on the topic and make informed decisions when it comes to investing in stocks that pay dividends.